Hello all, this is Stocky. Our today's topic is dividend investment. So, who invented dividends? It was the Dutch East India Company or VOC that was first recorded as a public company ever to pay regular dividends. The VOC paid annual dividends worth around 18% of the value of the shares for almost 200 years of existence from 1602 to 1800. Just as a general knowledge, I would like to give you an idea about two main dividend theories, which are 1. Irrelevance theory. According to irrelevance theory, dividend policy do not affect value of company, thus it is called irrelevance theory. 2. Relevance theory. According to relevance theory, dividend policy affects value of company, thus it is called relevance theory. This dividend irrelevance theory was developed by economists Merton Miller and Franco Modigliani in 1961, whereas relevance theory started from the VOC time as told previously. Okay, so now what exactly is dividend? A dividend is a payout of a portion of a company's profit to eligible stockholders, usually issued by a publicly traded company. Many of you might think, how did I never heard of this term? But actually dividend relates to an investment, particularly for an individual stock or a mutual fund. Well, not all companies pay dividends. Typically, the board of directors would decide whether their company deserves a dividend based on various economic factors. Most companies pay quarterly dividends, that is 4 times a year, which is currently directly deposited to your account. But there are some companies who also prefer to pay monthly or yearly basis as well. Did you ever think, what all can a company do with their profits? Well, a company has to do something with their profits. They can't just keep it as it is. They have many options for taking a decision on their profits. They can 1. Pay dividends to their shareholders. 2. Do retained earnings, that is put back in their business for growth. 3. Do research and development, that is R&D for their business using profit. Or 4. Buy back their own shares with the profit they got. To receive a dividend payout or distribution as it is called, a shareholder must meet certain needs. That is, you must be a shareholder of records, that is a registered owner of a security and who has the rights, benefits, and responsibilities of ownership on the date designated by the company in order to qualify for payout. Sometimes someday stocks are referred to as ex-dividend. It means that you will not receive a current dividend payout if you trade on that day. Now some of you might ask, why should I do dividend investment? And some might have a question, why should I not? So here are the pros and cons of dividend investment. First, let's start with the advantages. 1. Dividend investment is considered as safer than other risk assets. Stock market is not just intraday trading, it can be options, investment, bonds, mutual funds, and so on. Dividend investment is one of them. 2. Dividend investing stocks are less volatile and far from inflation. 3. It is a great source of passive income. Invest in dividend stocks correctly and do nothing. You would automatically receive payout time to time. 4. Drip dividend reinvestment plan would give you more shares. There are also few disadvantages of dividend investment. 1. Dividend investment or DI is usually sector concentrated. You cannot easily pick any stock randomly just for the sake of diversification. 2. DI distribution is not always guaranteed. A company might decide to stop payouts anytime. 3. Stocks with dividends would always grow slowly. And 4. High earners should of course pay tax. Now, to make a dividend investment, you need to be familiar with some terms, since you need to consider these factors while making dividend investment. One is dividend yield and the other one is dividend payout ratio. 1. Dividend yield is a ratio of how much cash flow you are getting for each dollar invested in a stock. Dividend yield is given by annual dividends per share by price per share. As stock price increases, its dividend yield decreases. For example, If you purchase 100 shares of the ABC company at $100 per share, that is a total investment of $10,000. ABC company, being in profit, decide to pay its shareholders $10 per share annually in the form of a cash dividend, which resulted in $1,000 of dividends. The annual yield is the total dividend amount divided by the cost of the stock, which equals 10%. If it was $200 per share instead, the yield would drop to 5%, since 100 shares now would cost $20,000. 2. Dividend payout ratio measures the percentage of net company income that is paid out to the shareholders in the form of dividends. Dividends payout ratio is given by dividends by net income. For example, net income of ABC company is $10,000. They decide to reinvest $8,000 in the company and payout of $2,000, so dividend payout ratio will be 20%. Anything around or above 35% ratio would be a serious point of consideration, since that company is not reinvesting for the chances of improvement in their business. There are a few other factors also that could be considered before investing in dividend stocks for assurance, but these two are the crucial ones. There is a thing called dividend calculator for ease. There are many links for a dividend calculator available online to analyze the returns before investing in a dividend stock. Just enter the values and check the dividend payout. For example, this is one online dividend calculator link named Code Beautify. You can select dollar, rupee, euro, or pound and just enter the input values according to concepts that we have seen till now. It calculated how much profit would I receive with my inputs and investments after 10 years. Since I calculated for 10 years, I would mention the link for this in the description below. Okay, so now just because you want payouts doing nothing, don't fall into the dividend traps without analyzing. Never fail to check out sector trends before picking a stock. Consider all the factors before investing in them. That's all about dividend investing. Thank you for watching. See you next time with a new topic. Till then, keep learning.